Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is David Beck. And David is a certified financial planner whose practice focuses on helping families plan for financing college educations. He has his own financial planning company, which is called Bay Area Planners. David came to the United States from England in 1982. He worked in product management for electronic component manufacturers, including Tyco. He saw the youth culture at high-tech companies and decided that wasn't where he wanted to be long-term, so he started a second career in financial planning. David graduated in 2006 from the financial planning program at University of California, Santa Cruz Extension. In November 2006, he was trying to help his niece with her questions about financing for her college education, and he decided to focus in that area, and it developed into his full-time business. He says he finds helping people in this area to be very rewarding. So David, thank you for being with me today.
My pleasure.
Now today we're going to be talking about how to pay for college using financial aid, tax benefits, family income, savings, loans. So college financing is a challenge for many people. It's becoming a more expensive proposition. Now, as we get started in this is just an introduction to this area, and help is available for further guidance. But bear in mind, David invested a lot of time and so forth to learn about this, and so it's helpful to have a resource like that to help you out in the process. And anyway, there's also resources we'll talk about on the internet and so forth. So David, let's get started. So what are the main sources of money to help families facing a large college tuition bill?
There's need-based financial aid, and then there's something called merit aid, which comes from the school itself. And then there are tax benefits. So the need-based financial aid and the merit aid, they're a little bit unpredictable. There are a number of factors. Some of those factors are under the control of the college, so you can't always predict those. The good thing about the tax benefits is that, driven by rules and regulations, that's very predictable.
Well, sort of predictable, as we're going to talk about, because we have some benefits that have been there for us recently, and now as we get into this, there's more of a question mark as to whether they will be available, and so we don't have as much consistency as we'd like. Yes, some uncertainty that's involved. All right, well, let's talk a little bit about this issue of tax benefits for higher education. And so why don't we just go ahead maybe and try to list some of these that are available or have been available, might be available.
Right. So for this year, that's tax year 2010. Just a couple of changes from previous years. There was something called the tuition and fees deduction, which was an above-the-line deduction on the first page of your tax return. That was for a deduction of up to $4,000. That didn't make it into 2010. Essentially, the benefit of that was replaced by something called the American Opportunities Credit. So that's not available this year and may or may not come back next year. One other slight change was that in 2009, you were allowed in your 529 plan to make different investments on two occasions during the year. In 2010, we were back to just the once.
So, okay. So a 529 plan, it's a special savings plan that parents can put aside for their children, and the income is not taxable provided the money is used for college education.
That's correct.
And so what they did was they they classified as education expenses some items that weren't before. And maybe could you...
Actually, what I was mentioning was 529 plans, because of their tax favored status, have some restrictions. One of the restrictions is you cannot trade in them like you would a regular account, a regular brokerage account.
Yes.
So the limitation, the idea is a sensible idea, is that the money is supposed to be for education.
Yeah, and it's long term.
It's a long-term investment. You put it into into a particular mutual fund or plan, whatever is in there, and then you're supposed to leave it there, and you can only move it.
Okay.
You can only move it from one investment type to another investment type once per year.
Okay.
Because of the problems in 2008, 2009, these plans were going down in value. They relaxed that rule, but it was just for that 1 year, not this year.
Okay, so that's what we're talking about, is actually what investments you held within the plan, and because of the market decline and so forth, they tried to give a little more flexibility for making adjustments for families.
The other big uncertainty that we were talking about when we opened here is the expiration of the Bush tax cuts from 2001.
Right.
So there's a number of changes in education there. The Coverdell Education Savings Account, we've been able to put $2,000 a year into that since 2001.
Right. This is like a special IRA for saving for college again.
Yes, a special IRA type. It's based on an IRA. But that $2,000, if the Bush tax cuts expire, will go down to $500.
Peanuts.
Peanuts. So if that happens, what can you do? Say you opened one a couple of years back.
Yeah.
It's got $4,000 into it, but now you can only put $500 into it per year. It's not really ever going to amount to that much. Well, one thing is you can just roll it into a 529 plan.
Okay. So
that's one change.
Right. Now, these Coverdell accounts, one reason why people like them is you had, I think, a little more flexibility as far as the type of investments that you could have in those plans.
Yes. I mean, we were just talking about the 529 plan, limiting you to not just like a 401k style limited selection of investment funds, but only limiting you to making one transaction a year.
Yes.
The Coverdell, you just treat it like an IRA account, virtually any type of investment you want, even options, and as many times during the year as you want.
Yes. Okay. And so the Bush tax cuts, today is November 30th, folks, and so here we are at the end of 2010, and Congress has not decided yet what the heck is going to happen with this stuff. They're going to be negotiating during December, and God knows whether they're even going to come to a decision before next year. But anyway, so there are many provisions, including, of course, just tax rates that are up in the air right now. The tax rates is the simple thing to talk about, that the maximum rate for individuals may go from 35% to 39.6%. And the rate for capital gains from 15% to 20%. But that's the easy stuff that we can talk about in a sentence, but we've got hundreds of things that are affected by this, and so, so just be aware, and it makes it a little more difficult to plan, and even for us to talk about these things to some degree. Why don't we talk a little bit about the American Opportunity Credit?
Yes, the American Opportunity Credit was introduced just over 2 years ago by President Obama, and it's a good credit. It's helping a lot of families in a number of ways. First of all, it's for more money. It's for $2,500 compared with the old Hope credit for $1,800. It goes to more families because the phase-out limit is higher, up to phase-out begins at $160,000 income or adjusted AGI for a family married filing jointly. So it goes to a lot more families than the old Hope credit. And then finally, part of it is refundable. $1,000 of the $2,500 is refundable. So a family that doesn't pay tax still gets the benefit of that $1,000.
Yeah, so that's a really nice benefit for education.
Right, and then on top of that, I forgot, it also applies in the junior and senior year of college.
Yes.
Whereas the Hope is only for the freshman and sophomore year. very useful credit, and that's due to expire at the end of the year as well.
At the end of 2010. So unless
Right.
Congress does something, no more American Opportunity Credit, and then that's going to be replaced with,
It would go back to the old Hope credit.
okay.
You know, we were talking about the uncertainty and how these educational aspects of the tax bills, you know, have a lower level of importance to the main ones, the personal income tax rates and capital gains tax rates and so on. I was looking to try and find what the approach is of you know, the Republicans as they come into the House now, and you know, will be the chair of these committees. I really can't. I really was unsuccessful in finding anything that would let me know, you know, what they're planning about these things.
Yeah.
There's a Republican senator, Senator Grassley, who is, you know, concentrates a lot on education, and what he wants is actually to extend all of these things. So that's, I guess, a hopeful sign, as
Yeah.
is the fact that they were brought into life during the Bush tax cuts. So presumably, you know, Republicans are more in favor of continuing this kind of help. In fact, Grassley would actually increase the American Opportunities Tax Credit from $2,500 to $3,000. However, that was before the Tea Party movement came along.
Yes.
And the concentration on budget deficits. So we will just have to wait and see how this plays out.
Yeah. So we sort of have a conflict going on here. On the one hand, we're concerned about budget, about spending more, if you will, than we're taking in, these deficits that are happening at the national level. On the other hand, we're worried about American competitiveness. And so are we going to be educating our young people in order for them to compete in a global marketplace?
Absolutely.
And so somehow we have to reach some sort of balance or something, or at least we have to decide, you know, what are the real priorities. And those priorities are going to be different depending on who you're talking to. If you're talking to a senior citizen, they're more concerned about protecting Social Security than maybe these education things, because they may not have a child that they're so concerned about, and they're worried about paying their bills, and, you know, paying for getting bread on their table. All right, well, let's go on to a few more of these. So how about the Coverdell account? Okay, you already talked about that. Goes back to $500. Student loan interest.
Student loan interest. This could be big. Right now, you can take a deduction on your taxes for student loan interest. If we revert to the pre-2001 situation, that deduction is only for the first 60 months. 60 months, 5 years. So considering that student loans are typically for 10, 20, even longer,
yes,
that would cause a good amount of that interest on that loan not to be tax deductible.
Yes.
And in fact, since 2001, something called income-based repayment has become popular and available. And that is when you graduate and you go into your first job, you know, you're not earning too much. If you can't afford the student loan, you can only pay what a small percentage of your income towards it, and the rest of the
you get a deferral.
amount, yeah, the amount that you didn't pay.
Why have a modest loan when you can have a humongous, overbearing loan that you'll never be able to pay off?
That interest accrues. So if you follow that income-based repayment, not make many payments during the first 5 years, you would probably find yourself then with a large debt, accrued debt, and no tax benefit for it.
Oh my gosh. Okay. How about the Section 127 that you're talking about here?